because I've been thinking about, besides the punitive measure in discouraging defect to encourage cooperation, I also want to talk about how we can incentivize the transition from greenhouse gas emitting energy source, especially fossil fuel, to renewable energy with green finance, because that's something that's been that's people have been using that at the moment. So green finance, and I want to lay out, try to have an idea. How is it that it's going on a little bit too slow? Uh, so the outline, I lay down something about capitalism, roughly, about trade, how we come to develop from self-sustenance to trade, and then I talk about money, how we transition into money, and then finance, the financial market, how it relates to money, and how it evolves over time. And then I'll talk about risk, and this will help us understand why the transition into renewability is so slow. And then I'll talk about how we can incentivize the whole transition. Trade, of course, way back when we started to hunt and gather and even farm our own land, agriculture comes a little bit later, but the hunting, gathering, that's when someone, maybe something like a family, get the food themselves, the shelter, and they're self-sufficient. But as we all know, afterwards there's something called the exchange of goods. You produce certain things and I produce something else. We specialized in our own production of goods, and then we barter. We have a marketplace, something like that, and then we exchange goods. So I do this and you do that. I'll do my best and you do your best, and then we'll increase our efficiency through specialized skills, division of labor, and that bartering is not with the mutual currency, it's not with money, but it's just trading goods, okay, based on need and wants. And back then, how valuable something is, it depends on something like the labor value. It depends on how much work is put into it, and of course, how much resources went into it, and how much time, energy, and work, and also resources measure how valuable something is, and the labor value measures the work that's been put into the production process. And that's a very old time. And then afterwards, we have money. And money is with more money, you can purchase more. And if you are able to produce more goods, you can exchange more money. And you would have increased your purchase power. So purchase power acquired with production of goods. And especially money is a common currency instead of like bartering. You exchange goods. Now we have a common currency. And with the common currency and the purchasing power, we see that there's, in an ideal world, we would have a just distribution of wealth through fair competition, right? You produce the good that you can, and then you sell your goods, and you would have the purchasing power through having acquired certain economic wealth, and that's a just distribution. And of course, the free market would have coordinated cooperation through pricing, right? The supply-demand curve, consumption, production, demand, supply, and then through pricing, we can know how much a certain thing we have to pay for. And that's the market value, and the market value interact with supply or production with demand. So that's how the price, the market value is set. And then even later on, there's the financial market, finance, right? Because we need capital, we need money from someone else to invest in our business. So it will empower growth and development. With more money, I can do more things and grow our business and even grow it better and better. So investment on the financial market, at least, is when you invest your money, and the money you invested, the business that you, the company that received your money, it will grow, and it will have some profit, and you will share the profit through your ownership of the share of the company, through the stock of shares that you have, and like a dividend, right? And so the stock market coordinate cooperation through brokerage of with buying and selling. So people buy and sell shares, stocks, and that's how we set the price for shares. Share price would interact with performance on assets with the free market. So a company has certain assets, like a factory has a factory and all the machines, and the performance, how well it uses the machine to produce, and also, of course, the production of goods, also how much money it makes, it interacts with the free market because of the supply and demand. So the share price interacts with assets and performance with the free market. Given all this, then we can think about the fossil fuel companies. People have invested in those companies, they've grown and they've developed, and they are at the moment the way that they are. They have their drilling site, they have their pipelines, they have their infrastructure. So that's the fossil fuel establishment. They've established what they are with a surely sustainable high yield across some time. So at least until the oil all consumed, they can still make quite a large sum of money. So that's for sure, and it's sustainable for a short while, and that seems to be a good thing. That's a return, a gain, a benefit across some time, for sure. But if they were to transition into renewable energy, the yield, at least at the short term, may be low, and they have a higher cost of establishment. They have to invest more money to build more infrastructure, let alone giving up their old investment, right? So the transition into renewability, it has an uncertain and low yield. So you can calculate, right? Something is certain and high yield. Another thing is uncertain and low yield. So it's internally, at least for the short term, rational to choose to go on the way that they've been doing business. And of course, in a free company, in a capitalistic free market, there's something called a market share. And if you were to have a retarded growth, people may begin to invest their money to some other companies. They will sell your stocks and buy someone else, and it might even threaten the survival of the company because of the market share and because of how little money you have invested in you. It might even run the risk of having to terminate your business, of going bankrupt, and that's a real risk. I mean, if you were to transition, and then after some time you will get back the money that you would have had in 30 years, but are you able to survive that 30 years? Maybe you would have died off, right, in a competitive free market. So green bonds, at least green finance, one of the instrument in the green market finances with green bonds. It encourage environmental, social, and corporate governance, ESG. It's something that people talk about right now, and also that would encourage at least new companies to focus on these things, and it would, I hope, also compensate for the transition cost. So for the old company, they have a better future to transition, because instead of having a low and uncertain return to transition, it might at least have a slightly higher return and a more certain return to transition. So they can, if they were to calculate in the longer run, and especially foreseeing that they will survive, let's say the 30 years, then it's better for them to transition. In the long run, instead of having the oil all drilled and consumed, they would have a much longer sustainable future. So with the green bonds and green finance, new energy companies on renewability will put selection pressure through the present market, because there are these new companies, they have the finance, they've got the capital through the green bonds, and they do their things, and they do it well, So those that are not as green would have the selection pressure to be better. With that selection pressure, and also with the selection pressure would put pressure on them to change, to transition. And the green bonds, if they were to benefit from this financial instrument, they would also have a lower risk of bankruptcy if they were to transition. So this green finance would have um, motivated them more to consider the alternative. And if you were to think 100 or 30 years, 50 years ahead, and you see that after a certain time, the whole point about non-renewable energy is that it's not renewable. After some time, you would run yourself out of business. It's just a matter of time. So it's for very long term, it's rational to transition. But it's just that if you were to transition and then you got bankrupt along the way, then it would have turned out better not to transition, and green bonds would have um, improved the situation for them. So a little very short recap of how we go from hunter-gatherer, agriculture, society, to trade, and then to trade with a common currency, money, and how we play with money through finance. But finance, investment, there are risks, and then with that, we try to understand why the fossil fuels company do not want to transition, and then we try to solve the problem by understanding green finance that we already have right now as incentivizing the transition.